$36 trillion. Say that number out loud. $36 trillion. It is a number so large that the human brain cannot process it intuitively. So let me give you a comparison. If you spend $1 million every single day, every day, without stopping, it would take you almost 100,000 years to spend $1 trillion. The United States owes 36 of those, and it is adding roughly 2 trillion more every single year. At current trajectory, interest payments alone on that debt will exceed the entire US defense budget within the next few years. More money going to bondholders than to the most powerful military on Earth. Now here is the question that official Washington refuses to answer directly. What happens when the largest debtor nation in human history can no longer service its debt? What happens to your savings account, your pension, your mortgage, your salary? What happens to the dollar in your pocket? Politicians will tell you it cannot happen. Economists will tell you America is different. Central bankers will tell you they have the tools. History tells a different story. Because America is not the first great power to accumulate debts it cannot repay. Spain did it. France did it. Britain did it. Rome did it. Argentina has done it 9 times. And every single times, without exception, the people who paid the price were not the governments that borrowed. They were the ordinary citizens who trusted those governments with their savings, their pensions, their futures. Every single times. Tonight we are going to travel through 2000 years of sovereign default, from the Roman Empire to modern Argentina, and we are going to answer the question that nobody in official Washington wants you to ask. What happens to your money when the government cannot pay its bills? My name is Max. I watch the past to understand the present. The answer to this question is not comfortable, but it is the most important financial education you will ever receive. Let's begin. Part 1. What is sovereign default and why it matters to you? Before we go into history, we need to establish something clearly. What exactly is a sovereign default? A sovereign default occurs when a government cannot or chooses not to meet its financial obligations. This can take several forms. Hard default. The government simply stops paying. It tells bondholders, we owe you money and we are not going to pay it. Soft default. The government changes the terms of the debt. It extends the maturity. It reduces the interest rate. It pays back less than was promised. Technically legal, economically identical to not paying. Inflationary default. The government prints money to pay its debts. It meets every obligation in nominal terms, but the money it pays back is worth dramatically less than the money that was borrowed. This third type, the inflationary default, is by far the most common and by far the most insidious because it is invisible. Nobody announces it. Nobody votes on it. Nobody sends you a letter saying, we are reducing the value of your savings by 40%. It just happens, slowly, then all at once. And here is why this matters personally to you. If you have money in a savings account, a pension fund, a bond portfolio, a life insurance policy, you are a creditor of the financial system. You have lent money directly or indirectly to banks, corporations and governments. When governments default, in any of the 3 forms, creditors pay the price. That means you. Now let us look at what this has looked like throughout history. Part 2. Rome, the original too big to fail. We have discussed Rome before on this channel, but today we are looking at a specific aspect of Rome's financial collapse. The moment when the Roman government effectively defaulted on its obligations to its own citizens. Rome's financial system in its prime was built on a promise, the promise of the denarius. A silver coin of consistent weight and purity that soldiers, merchants and citizens could trust. The Roman state had obligations, paid allegiance, fund the grain dole for Roman citizens, maintain the infrastructure of empire, finance the bureaucracy. For centuries, Rome met these obligations honestly. Then came the pressures we have discussed: endless frontier wars, civil conflicts, plagues, the sheer cost of maintaining an empire stretching from Scotland to Mesopotamia. The treasury could not keep up, and so Rome did what every government facing impossible obligations does. It debased the currency. The denarius, originally 95% silver, was gradually diluted. Under Nero, 90% silver. Under Marcus Aurelius, 75%. Under Septimius Severus, 50%. By the crisis of the 3rd century, 2%. A coin that had once been nearly pure silver became a copper coin with a thin silver wash that rubbed off in your hand. This was a default, not announced, not voted on, not acknowledged, but a default nonetheless. Every Roman citizen who had saved in denarii, every soldier who had been promised a pension in silver, every merchant who had priced contracts in the old currency, they all received less than they were promised. The purchasing power of their savings evaporated with the silver content of the coin. What happened to ordinary Romans? Prices exploded. A modius of wheat, roughly a peck, cost half a denarius under Augustus. By the 3rd century it cost tens of thousands. The middle class, the backbone of Roman stability, was destroyed. Merchants stopped accepting coins and demanded payment in kind: grain, oil, gold. The money economy partially collapsed. Barter returned. The social contract, the implicit promise that hard work and saving would be rewarded, broke down, and into that breakdown came instability, extremism, and eventually the collapse of the Western Roman Empire. The first lesson of sovereign default. Governments do not default on their debts overnight. They default gradually, through debasement, until one day the currency has lost all connection to the value it once represented. Sound familiar? Part 3. Spain, the empire that defaulted 8 times. If Rome is the ancient cautionary tale, Spain in the 16th and 17th centuries is the medieval one. And it is particularly instructive because Spain in 1550 was the America of its day, the most powerful empire on earth, the largest economy, the military superpower, the center of global trade. Spain had something America has today, the closest thing to a global reserve currency. The Spanish silver dollar, the piece of 8, was the dominant currency of global trade. From the Americas to Asia, merchants priced transactions in Spanish silver. Sound familiar? Spain also had something else America has today, an apparently inexhaustible source of new money. For Spain, it was the silver mines of Potosi in Bolivia, the most productive silver mines in the history of the world. For America, it is the printing press and the dollar's reserve currency status. Both created the same dangerous illusion, that the money would never run out. It always runs out. Spain's problem was simple. It spent more than it earned. Wars against France, wars against the Ottoman Empire, wars in the Netherlands, the maintenance of a global empire on 3 continents. The silver from Potosi flowed in. The military spending flowed out faster. And so Spain borrowed from German banking families, the Fuggers, the Welsers, from Italian bankers in Genoa, from wherever it could find credit. Philip II of Spain, the most powerful monarch on earth, defaulted on Spanish debt in 1557, then again in 1560, then again in 1575, then again in 1596. 4 defaults in 40 years. Each time, he negotiated new terms with his creditors. Each time, the creditors, who had no other option, accepted reduced payments and extended timelines. Each time, Spain borrowed again. The pattern continued after Philip II. Spain defaulted in 1607, 1627, 1647. 8 sovereign defaults between 1557 and 1696. What happened to ordinary Spaniards? The constant currency manipulation and fiscal chaos produced persistent inflation. The Spanish middle class, merchants, craftsmen, professionals, found their savings constantly eroded. Interest rates on private borrowing became astronomical as the government crowded out all other borrowers. Investment in productive industry collapsed. Why build a factory or a farm when the government might seize your assets, debase the currency, or simply stop functioning? Spain, despite its vast empire and silver wealth, failed to industrialize, failed to develop the commercial economy that was emerging in England and the Netherlands. Historians debate the causes, but the fiscal chaos, the constant defaults, the currency manipulation, the unpredictable government behavior was a central factor. The second lesson: sovereign default does not just destroy current savings, it destroys the confidence necessary for long-term investment. Countries that default repeatedly condemn themselves to economic stagnation. Part 4. France. The default that caused a revolution. France in the 18th century, the most populous country in Europe, the center of Enlightenment culture, the home of Voltaire, Rousseau, the encyclopedista, and completely, catastrophically bankrupt. France had fought and largely financed the American Revolution, not out of love for American liberty, out of desire to weaken Britain. The war cost France approximately 1.3 billion livres. France had also fought the War of Austrian Succession, the 7 Years' War, and was maintaining the most lavish royal court in European history at Versailles. By 1788, France was spending roughly 50% of all government revenue on debt service alone. Half of everything the government collected in taxes went straight to bondholders before a single soldier was paid, before a single road was built, before a single official was salaried. The government tried everything: new taxes, cuts in royal expenditure, borrowing from new sources, accounting tricks that would make a modern Wall Street banker blush. Nothing worked. In August 1788, France effectively defaulted. It suspended payments on its debt and called an emergency meeting of the Estates General, the first time this body had met in 1705 years. That meeting and the chaos that followed led directly to the French Revolution, the storming of the Bastille, the guillotine, the terror, the execution of the king and queen, a decade of revolutionary war across Europe. Tens of thousands of people died in the political explosion triggered by a government that could not pay its bills. The French revolutionary government's solution to the debt crisis: print money. They issued a paper currency called the assignat, backed by confiscated church lands. Initially it worked. Then they printed more, then more, then more. By 1796, the assignat had lost 99% of its value. A new hyperinflation, a new destruction of savings, a new devastation of the middle class. Until Napoleon restored monetary order, but only after a decade of chaos that had killed hundreds of thousands and transformed the political map of Europe. The third lesson: sovereign debt crises do not stay financial, they become political, and political crises become social crises. The arc from bankruptcy to revolution is shorter than most people believe. Part 5. Argentina, the modern case study. Now let us come to the modern era, because some people will say, Rome, Spain, France, these are old stories. The modern financial system is different. Central banks, the IMF, Global markets. These create safeguards that did not exist before. Argentina says otherwise. Argentina in 1900 was one of the wealthiest countries on earth. Its GDP per capita was comparable to France. Buenos Aires was called the Paris of South America, a city of boulevards, opera houses, universities, and a confident middle class. Argentina had vast agricultural wealth, the Pampas among the most fertile land on earth. It was the world's largest exporter of beef and wheat. It had every reason to be permanently prosperous. Instead, it has defaulted on its sovereign debt 9 times. 9 times! The most recent major default, December 2001. What happened? Argentina had pegged its peso to the US dollar. 1 peso equaled $1, in an attempt to stabilize its currency and attract foreign investment. It worked for a while. Investment flowed in, the economy grew, the middle class expanded, but the government kept spending more than it earned. The debt kept growing, and the dollar peg meant Argentina could not inflate its way out of the problem. By 2001, the government was clearly insolvent. The IMF imposed austerity conditions. The government froze bank accounts, a measure called the corralito, preventing Argentines from withdrawing more than $250 per week from their own savings. Think about that. Your money is in the bank. The government decides you cannot have it, not because you did anything wrong, because the government borrowed too much. Riots erupted. The government fell. 5 presidents in 2 weeks. In January 2002, Argentina devalued the peso. Overnight, it went from 1-to-1 with the dollar to eventually 3-to-1. Anyone with peso savings lost 2/3 of their wealth in a single night. Anyone with dollar-denominated debts, mortgages, car loans, business loans, saw those debts triple in peso terms overnight. Middle-class families who had saved in pesos for decades, for retirement, for their children's education, for their homes, lost the majority of their wealth in a matter of weeks. The poverty rate in Argentina went from 35% to 57% in less than a year. People who had considered themselves solidly middle class were suddenly poor, not because they had made bad decisions, not because they had been reckless, because they had trusted their government with their savings, and their government had failed them. This is not ancient history. This happened in 2001, 25 years ago, in a modern, educated, sophisticated country with a functioning democracy. The fourth lesson: modern financial systems do not prevent sovereign default. They delay it, obscure it, and sometimes make it worse when it finally arrives. The corralito, the government freezing your bank account, is not a medieval concept. It happened in 2001. It could happen anywhere. Part 6. Greece 2010. The default that couldn't be called a default. Greece 2010. A member of the European Union. A member of NATO. A democracy with ancient roots. A country so culturally central to Western civilization that its language gave us the words for democracy, philosophy, economy, and crisis. Greece had joined the Eurozone in 2001, and being part of the Euro gave Greece access to borrowing at rates it had never previously enjoyed. German-level interest rates for a Greek-level economy. Greek governments borrowed enthusiastically. They funded generous public sector wages, early retirement at 50 for many workers, large social programs, and an Olympic Games in 2004 that cost several times the original budget. By 2010, Greece's debt was 146% of GDP. Its deficit was 15% of GDP. The numbers were completely unsustainable. The markets figured this out simultaneously. Greek bond yields exploded. The cost of borrowing became prohibitive. Greece could not roll over its debt. The EU, the ECB, and the IMF organized a bailout, but with conditions. Severe austerity, pension cuts of up to 40%, public sector wage cuts of 25%, mass privatization of state assets, tax increases across the board. The Greek economy contracted by 25% over 5 years, a depression deeper than America's Great Depression of the 1930s. Unemployment reached 27%. Youth unemployment reached 60%. A generation of young Greeks left the country. The best educated, most talented Greeks went to Germany, Britain, Australia, anywhere that offered work. A brain drain that will affect Greece for decades. In 2012, Greece conducted the largest sovereign debt restructuring in history. Private bondholders were forced to accept losses of approximately 50% on their Greek government bonds. It was not called a default. It was called a voluntary restructuring. The fifth lesson: when a sovereign default is politically inconvenient, governments and institutions rename it. Voluntary restructuring, debt reprofiling, quantitative easing. The words change. The economic reality does not. Part 7. The American question. Now we arrive at the question that has been underneath this entire conversation. Could it happen to America? Let us look at the numbers honestly. The debt, $36 trillion in national debt, growing at approximately $2 trillion per year. Debt to GDP ratio approaching 125%, higher than at any point in American history except the immediate aftermath of World War II. The interest burden, interest payments on the debt now exceed $1 trillion annually. This is more than the US spends on Medicare, more than on the military, and it is growing every year regardless of what else the government does. The structural deficit. Even in good economic times, the US government spends significantly more than it collects in taxes. There is no realistic scenario under current policy where this changes without either dramatic tax increases, dramatic spending cuts, or both, none of which is politically achievable in the current environment. The dollar's protection. Here is the crucial point where America genuinely differs from Rome, Spain, France, Argentina, and Greece. America borrows in its own currency, and that currency is the world's reserve currency. This means America can always print dollars to meet its dollar obligations. It cannot technically default the way Argentina defaulted. It can always print the money. But printing the money is the inflationary default, the invisible one, the one that destroys savings without anyone going to jail or any government admitting fault. The question is not whether America will default. The question is which form the default will take. Hard default, explicitly refusing to pay, is politically almost unthinkable. Soft default, renegotiating terms, would be catastrophic for dollar credibility. Inflationary default, printing money, eroding the real value of the debt, is the path of least political resistance. It is also the path most destructive to ordinary savers. Because inflation is a tax on everyone who holds dollars, on everyone with a savings account, on everyone with a pension, on everyone who has worked hard and saved carefully and done everything right. The people who are protected are those with assets, real estate, stocks, gold, commodities, things whose prices rise with inflation. The people who are destroyed are those with savings, cash, bonds, fixed incomes, things whose real value falls with inflation. This is not a new observation. This is the pattern of every inflationary default in history. The rich have assets, the middle class has savings. Inflation transfers wealth from the middle class to the asset-owning class, every time, without exception, for 2000 years. Part 8. The mechanisms. How it actually happens. Let us be specific about the mechanisms. Because the dollar might lose value is abstract. What that actually means for your daily life is concrete and important. Mechanism 1. Direct inflation. The most obvious. More dollars chasing the same amount of goods. Prices rise. Your salary buys less. your savings account loses purchasing power. We have already seen this. Between 2021 and 2023, cumulative inflation in the United States exceeded 20%. A person with $100,000 in a savings account in 2020 had the equivalent purchasing power of roughly $80,000 by 2023. $20,000 of real wealth quietly transferred away without a single news headline saying government takes $20,000 from middle-class savers. Mechanism 2. Financial repression. This is the sophisticated version used by governments that want to reduce their debt burden without triggering obvious inflation. The government keeps interest rates artificially below the rate of inflation. Your savings account pays 1%. Inflation runs at 4%. You are losing 3% per year in real terms, every year. Meanwhile, the government is repaying its debts in money worth 4% less each year. A quiet, gradual, invisible transfer of wealth from savers to the government. This is exactly what the United States did after World War II, when it had debt of 120% of GDP. It kept rates low while allowing inflation to run. Over a decade, it reduced the real debt burden substantially. This mechanism works. It works at the expense of savers. Mechanism 3. Dollar devaluation. If the dollar loses its reserve currency status, or even if its dominance simply diminishes, the cost of imports rises dramatically. America imports enormous quantities of goods, electronics, clothing, food, oil. A weaker dollar means all of these cost more, which means inflation, which means the mechanism above. China, Russia, Saudi Arabia, Brazil, India are actively working to reduce their dependence on the dollar for international trade. This is not a conspiracy theory, it is documented policy pursued openly by multiple major governments. If even 20% of global trade that currently uses dollars shifts to other currencies, the impact on dollar purchasing power would be significant. Mechanism 4. The pension crisis. This is the silent catastrophe most people are not watching. Pension funds, state, municipal, corporate, depend on earning sufficient returns to meet their future obligations. In a low interest rate environment, bonds yield almost nothing. Pension funds have shifted into riskier assets, stocks, private equity, real estate, to try to hit their return targets. If there is a major market correction, pension funds that are already underfunded could face catastrophic shortfalls. The people who would lose are the retirees depending on those pensions, the teachers, firefighters, government workers who were promised a specific monthly payment and may not receive it. Part 9. Those who survived. The pattern across 2000 years. In every sovereign debt crisis we have examined, Rome, Spain, France, Argentina, Greece, the same pattern of survival appears. Not the people who predicted the crisis, not the people who shorted the government bonds, not the financial geniuses. The people who survived were those who had made simple, boring decisions years before the crisis arrived. They held real assets. Roman senators with land survived while urban Romans with savings in denarii were destroyed. Spanish merchants with ships and goods survived better than those who held government bonds. Argentine families who had converted pesos to dollars or who owned farmland survived better than those with peso savings accounts. Argentina. Greek citizens with property in Germany or Cyprus survived better than those with bonds in Greek banks. Central Bank. Real but assets, the patterns of history do not care about commodities. Gold have consistently maintained the real value through sovereign debt than it earns, paper accumulating debts savings cannot honestly government repay, bonds, pensions, relying on financial mechanisms that delay the reckoning rather than solving the across currencies and countries. Read that question again moved money and to answer it honestly about the United States who held dollar accounts. The answer is not a prediction of traded in gold. History shows that fiscal crisis can be delayed for much longer than anyone expects, provided Japan has had debt above 200% of GDP for decades without finding across 2,000 years of financial history. Also unique. Gold has maintained its purchasing power through the Roman debasement, by Japanese through the Spanish fiscal crisis, through the French revolutionary deflation. The answer is not a reason to panic. Through Argentina, panic is never a good financial strategy. Through the 2008 financial crisis is a reason not to ask yourself a not simple without question. Volatility. Is my financial life structured in a way that depends entirely on the continued perfect functioning when paper of a system that history shows does not function perfectly forever? The people destroyed. If all of your savings are in dollar-denominated accounts, people with mortgages, if all of your retirement is in dollar-denominated bonds, when currencies devalue, if you have significant chaos arise, if you have no debt becomes a crushing burden, you are the person with no debt as the Roman citizen. The person with significant debt is trapped in the year 200 AD. Not doomed, not immediately at risk, but more exposed than you need to be to a risk that history shows is real. The solution is not dramatic, it is not radical, it is not selling everything and buying gold bars. It is simply this: diversify, hold some real assets alongside paper ones. Reduce debt where possible. Think about where your wealth is concentrated and whether that concentration makes sense given what history shows. Outro: the note that never came. In December 2001, millions of Argentines went to sleep with their savings in the bank. They had done everything right, worked hard, saved diligently, followed the rules, trusted the system. They woke up to find that the government had frozen their accounts. No warning, no note, no apology, just a new rule. You cannot have your money, not yet, maybe not ever, not at the value you deposited it. Most of them had never heard of sovereign default. Most of them had never studied the history of Spanish fiscal crises, or Roman currency debasement, or French revolutionary inflation. They had simply trusted their government would honor its obligations. History shows, with cruel consistency, that governments honor their obligations until they cannot, and then they do not. The people who were protected were not the ones who predicted the exact date. They were the ones who understood the pattern, the ones who had quietly, without drama, without panic, without abandoning the system entirely, held something real alongside what the system promised them. You are reading this before December 2001 arrives. Whenever it arrives, whatever form it takes, the note is not coming. It never comes. But history is speaking. If you are listening, you still have time to act. My name is Max. I watch the past to understand the present. $36 trillion. And counting. Subscribe, and let's survive history together. See you in the next era.